Mike Tyson said everyone has a plan until they get punched in the face. And if you've been trading long enough, you know exactly what that feels like. Today, let's talk about having a plan B.
Let's take on the hourlies here. The next one's going to be pound dollar. And pound dollar is going to be in a very similar situation. I would call this one a little bit better than the euro dollar if you're looking for opportunities, but a similar situation. So the pound dollar is at a previous level of structure. I would call this a minor level of structure because it's not at the top of a swing, right? We know our swing looks like this. Top of our swing would be here. Bottom of our swing would be there. But you can see that we have a little bit of a pullback here. And if we look at the wicks, right, we know that these big wicks to the upside, what type of story do they tell us? Yep, they tell us the story of rejection, right? Price action has tried to retrace off of this. So if we look at both of these in its own right, again, this is why wicks are going to be important. This one down here tells us that price pushed all the way down here, got slapped in the face, and rejected. We came back down. We tried to push up again. Price came all the way up here. We got slapped in the face and then rejected, right? So we know if the bears protected this level in the past, do you think they're likely to try and protect that level in the future? Yes. Yep. So the wicks give us that. Just looking at one more example to the downside, right? If I wanted to ID a level that I'd be interested in like buying at on the downside, I would take a look at this rejection level right here because again, this is an area that the bulls protected in the past. I would expect them to protect that level again. So that would be a nice level to look for longs at. So we're at this minor level of structure. We are 2/3 through a 3-bar reversal, right? We have a high momentum candle. We have an indecision candle. If we got a lower low, lower close, that would give you a 3-bar reversal. So this is actually a level that's not a bad level to look for shorts. However, the problem is, I think, is there enough room to make profit? So if you were looking for shorts here, where would you be comfortable taking shorts to? And again, here's some bigger perspective. We're not in any type of underlying trend. We've been going sideways, right? So where would you be interested in taking shorts to? Shoot me some digits. I would be interested in a return to our inside level of structure here. That's going to be 134.40s. Mo says 134.35. Steve 134.35. So all about the same level. Beverly says 135.30. So it looks like we're all looking kind of in the same level between here and here. So just going off of where we project price to go to and where targets or where stops would go to, we probably don't have to measure this out to see that we wouldn't have a positive risk reward. Would you guys agree? I mean, if I look at my stop loss, if I'm using the ATR stop and I get above the highs here, that's going to put me at 134.73. So an ATR stop would put me right here. If I know I require a 1-to-1, what I can do is I can take my Fibonacci retracement tool out, drag it from my stop loss to my target, and I know that any entry below this level would not give me a 1-to-1. Well, if I need a lower low, lower close as my entry, it's impossible to get it there. So that won't work. So right now, you can just scrap the trade or wait for like, hey, maybe I'll get like a double top or something like that. Now, if you're able to go down to the 15-minute or maybe a range bar chart, that will give you potentially a different story. So if you're someone that's looking for a lower low, lower close, you got one right here. Are you going to have a double top? That's not going to happen. We've ran off that level already. Let's say maybe you can find an alternative reason for entry to make it work on the 15. But I don't really see much right here. Let's go down to a range bar chart perhaps. We're going to go down to a 5 range, which is going to be a little bit smaller than the 15-minute chart. And maybe that gives us a different story. So here on the range bar chart, do you guys see, I'll mark it up, do you guys see any way you could have gotten involved? This is going to be the beauty of looking at range bars. We also have a much clearer look at these structure levels. Again, this was the same level we looked at on the higher time frames. We had kind of our inside structure right here. this is a little bit clearer here. You guys see anything here on the range bar chart that we had? A double top, right? A double top. Price came up, uno top, dos top, right? So double top at structure. Let's measure this out. Stop loss, 5 pips above, because we know we're on a range bar chart. Actually would have been this white candle right here. So our stop loss would have been taken off of this. 134.66. So would have put a stop loss right here. Targets are the same. Inch them up a little bit higher. I think I have mine at 134.40. Let's put them at 134.42. Let's measure out this risk reward. Bada boom, bada bing. Range bars gave us an entry. So didn't necessarily have an entry on the minute chart. This is why I love going down to the range bar charts when I was a day trader, guys. Range bar chart, and this is the same. It's the same ATR, right? So this is the equivalent of the 5-minute. Gave us a nice entry. Now, Jay already answered my question. Darn it, Jay, I was going to make a whole big lesson out of it. I was going to say, so guys, I know this is hindsight analysis, and you're saying Akil, the double top already existed. What can I do now? When I'm Akil's like, well, this is educational purposes for future reference. Yeah, but what if I want to get involved now? What do I do? Well, what would you guys do? And then Jay, who is already in my brain, which is a weird place to be in. Don't stay in there too long, Jay. You might get stuck. Do you scrap the opportunity, or do you say, hey, what's my plan B? And plan B would be a 26.18. So if price can, oh, we did. Oh no, Jay, we might have had the 26.18 already. Oh no. Because it looks like we did break and close below here. Now it doesn't matter. We can, going back, this will actually be a really good lesson. So it looks like we had our 26.18 already. Broken close below here, came back up. If you're an aggressive 26.18 trader, meaning you put a limit order right at the 618, you're involved. If you're looking for any type of lower low, lower close, you never got that. So that happened already. So now is the trade over, guys? We plan A, double top, already gone, we missed it. Plan B, 26.18, already gone, we missed it. Man, what do I do? Does anyone remember that lesson that we spoke about before the break? We did like an hour on flag patterns, talking about why you shouldn't care if they're a flag pattern or not. Yeah, we can look for the same thing, right? Okay, well, this lower low, lower close is our fresh break, right? So what do we need to reset the process? Well, if we get a fresh break, that gives us our new structure low. Then I can still look for a pullback. Has our projection been fulfilled? Right? The projection of that price is going to go here. So each time we get a fresh break, just look for another pullback and you have your opportunity to trade it lower. Now, once we get to that level, then the opportunity is over. But until we get there, the market may give you multiple chances. So yeah, if you get a fresh break here, as long as it doesn't go down to the targeted level, look for that pullback and look for another reason to get involved. Boom. Why do range bar charts look so different? So the candlesticks are the same, right? They have the same qualities. They have opens, they have highs, they have closes, they have lows, they have bodies, and they have wicks. So the candlesticks are exactly the same. We measure them the same way. The difference with range bars is that on a time-based chart, right? And by time-based, I mean like 15-minute, 30-minute, hourly, whatever. Each of these candles represents a time-based session, right? So on a 15-minute chart, how many minutes does each of these candles represent? Well, 15 minutes, right? So price can do a lot of finagling and moving within 15 minutes. On a range bar chart, instead of being based off of time, each of these candles is based off price action trading within a specific range. So I'm on the 5 range chart right now, although it says 50 because of stupid micro pips. This is a 5 range chart. So every single one of these candles, Beverly, guess what their range is. Guess how big they are. 5, right? So there's no time taken into account. Each of these candles are exactly the same size range-wise, right? So what that does, and same thing if you're using like tick charts or another way to do it. What that does is it provides in my opinion, a much smoother look at price action. You get a better look at
the ebbs and the flows that happen in a move, right? So if I'm on a minute-based chart and I get a let's say a candle that opens here, and then we go all the way up here, right? And then we come down a little bit here, and then we end up closing up here, right? I'm going to get a candle that looks like this, right? Lots of information there, I know. On a range bar chart, that same move is going to look like this, right? Candle started here. We came all the way up here. We came all the way down here. And then we closed up here, right? So that's going to be broken up into different candles. So you may see the pullback here that you won't see here. So sometimes it gives a different perspective, I like to call it. I don't want to say it's better or worse, right? We spoke about the importance of wicks. On a range bar chart, you're not going to get those big wicks, right? So that has its own pros and cons, right? You may get a candle on a minute chart that approaches a previous level of structure and ends like this. And let me ask you guys this question, right? What type of, what story does this candle tell you about the market? Imagine that blue line being structure. It schemes rejection. On a range bar chart, because it's broken up, you may have something like this happening. So it does give a different story. So in my opinion, you got to use the minute-based charts or time-based charts and the range bar charts together. When I day traded, I always went time-based first through my IP, and then the range bar chart just to get a different perspective specifically for entry. I didn't necessarily do my analysis on the range bar charts. I made my predictions or identified what I need to identify. I made my predictions off of the time-based charts. And then the range bar charts were simply like going down to a lower time frame after I already made up my directional bias. So you do got to be careful with that because they could give you different signals. But yeah, I absolutely love them because it provides more opportunities and a different perspective on the market. And I used to absolutely, I get all glowy face and flushed out every time I think about range bar charts. I used to love them as a day trader. So, but yeah, so here's a good example of a range bar chart providing an opportunity that a minute-based chart may not, or a time-based chart may not actually do. So good stuff there. And a good trading opportunity. I don't know how many pips are available here. I didn't look. 58. You get 15, 20 pips out of a day trade. You're in business. So yeah, not a bad opportunity here on pound dollar. So real quick before uploading this, I want to show you a recap of the trade. You can see price ran down right to our level, at least the lower part of our level, then gave a little bit of a bounce, and it's actually continuing a little bit lower. Again, my projection wouldn't necessarily be down here, but hey, at least the first part worked out well. And then a little glance on the range bar chart as well with all of our markups. So again, simple analysis. You don't need to do anything fancy. Just understand how to read a price chart. And if you can get a little different perspective to help you out a little bit or give you a reason to get in, then hey, it's worth it. Being a lower time frame trader means keeping a close eye on the markets. And that usually means having multiple charts open at once. But how many monitors do you actually need to be successful? Is it 1, 2, 4, 8? If you're curious about the answer, check out this video as we break down the truth about trading setups and whether having more screens actually makes you a better trader, or does it just give you more things to get distracted by? The answer may not be what you expect. Check it out.